Just remember one thing, JG. The older you get, the higher your hairline. You get too tall for your hair, and then it'll start to shine. Yeah, and then you'll have to powder. You'll get it. You'll get it.
Oh, I'm already getting it, bro. I'm already getting it. Trust me. All right, everyone, welcome to another episode of Rein It In. And today we have 5 sticky notes, and albeit we just have 5, Patrick, and we've covered more before in this show. These are 5 big sticky notes. I can't promise we're going to stick to any particular timeline in this show because we're going to talk about bank failures. We're going to talk about affordability. We're going to talk about Alberta and inflation. It wouldn't be a Rein It In show if we didn't talk about Alberta for Mr. Alberta. We're going to talk about creative buying, and we're going to talk about the new China-Russia deal, which is brand new, 24 hours old, and still the pieces of the dominoes are shaken out. It's going to be a big show, lots to talk about. Let's get into it.
Let's throw one additional one in there, and we got to speak to the fact that Freeland is going to be releasing her budget, and I read an article just this morning about how much she wants to spend.
I'm not surprised on 2 counts. Number one, I'm not surprised that you wanted to throw in Freeland. We already have a slide, a Justin Trudeau, throw him under the bus slide. Now we're going to have a Freeland. When's that budget coming out, Patrick? Just by the way.
Sometime, I think late this month, late into March. So within the next week or so, I think. Maybe it's April. I've lost track. I was just so put off by the fact that, she's saying we can't do it the way we did before. The pandemic has been a big problem. We're going to have to approach it differently. We're going to need a bigger budget. Those aren't her words, but basically that's what she said. And, I say it's not the pandemic's fault. We got to be clear on that. It's not the pandemic's fault. It's our reaction or overreaction to the pandemic that caused all the problem. And I'll stop there.
All right, let's get into it because we got a lot to talk about. All right, folks, let's get started, Patrick, and talk about these bank failures. You know what's amazing is we shot this show 2 weeks ago, and literally the day after, we started getting this news of SVB. The Silicon Valley Bank was going to maybe go under and so on and so forth. Then it all kind of went down on Friday through Monday. And then we started getting kind of some dominoes falling. And now we've had 4 banks, 3 of them regional, one of them a pretty big bank. Credit Suisse is a huge bank that have failed. And maybe some more. I got to say, I'm hearing from a lot of people. They're a little freaked out. What does this mean? We've seen the kind of contagion, if you will, where people are trying to take out their money and so on and so forth. We've had a little bit of panic in the market, no doubt about it. Let's talk about it because investors, they want to know, how's this going to affect them?
Well, when you look at what's happening in the U.S., as Canadians, we always have to consider the fact that what happens in the U.S. has a big ripple effect. That saying is that when the U.S. sneezes, Canada catches a cold. It goes right across the board. And certainly what's happening in the banking system over there just causes nervousness at a global level. And of course, what we see here happening in Canada is people are also a little bit nervous. Now, we have to really shine a light on the fact that Canadians' banking system or Canada's banking system is way different than what happens in the U.S. So money is safe. But what's happening in the U.S. is they're trying to protect from that bank run. People don't understand one fundamental. A lot of people don't understand one fundamental, JG, and that is that we deposit money into the bank and we think, oh, there's our little bundle of cash sitting somewhere in a corner of a vault. And nothing could be further from the truth. The minute you deposit your cash, it's no longer your cash. The bank takes it over and they do what they do with it in terms of investments and lending. And that's what a bank's job is. So what they're afraid of, especially in the US, lesser degree in Canada, would be a bank run where people get really nervous and going, oh my gosh, if banks are collapsing, I got to get my money out. So they all run to the bank to get money out. Well, the bank doesn't have your money.
No, God, please, no.
And so this is where the problems start to, I guess, escalate and where the feds have to step in and try and calm people down. And that's what's happening actually in the U.S. right now. You hear the narrative, Yellen saying, no problem, the banking system's not at risk. Biden comes out and goes, hey, this is all good. We're here. We got you covered. And I think, a lot of people believe that it's always the opposite of what they're saying because they're politicians.
Yeah. So let's I think we should dive into a couple different things. Number one, what you just said, you opened up the door there. So let's explain that, which is if the bank has, the bank is mandated, and different banks have different mandates, and the US has very different mandates in Canada, which I'll touch on in a second. But essentially a bank never has more than 3% of its assets in reserve, even, and sometimes it's much less than that, Patrick, which means they've taken a dollar and leveraged it about 97 times, if you will. Like, the number is astronomical in terms of how much they multiply these dollars, which is why when people want their money and everybody wants it all at once, it creates a big issue. And what's been happening recently is all these banks, and now the microscope's on the majority of these banks. What's happening is most of these banks have had huge depositor decreases in the last 12 months. And that's because interest rates are way up and people are putting their money elsewhere. They're not putting it in the bank. They're putting it in bonds or putting it in different investments. They're just not putting it in cash in the bank because it doesn't get much in cash in the bank, whereas you can get a better rate if you bought a treasury bill or a bond or a money market fund or whatever the case may be. So the point is that depositors are really decreasing quickly. Some of the big banks are releasing 20% decreases and now are actually posting some pretty major operating losses because of this. So that's kind of where the issue starts. Then there's obviously the issue about, how they invest this money and why those returns are not coming in. There's been and every bank has different issues there, where Silicon Valley Bank is heavily into tech, and we'll talk about that in a second. The point is this: even though it's a very different system in the US versus Canada, what happens in the US will reverberate in Canada. Now, I want to read you something here, Patrick, because it's important for everybody to realize the differences between the two banking systems, the Canadian system versus the American system. So let me give you this. Since 2001, okay, so for starters, Canada counts 34 domestic banks in total, whereas the US counts more than 4,000. So that's not a 10x, that's a more than 100x in terms of number of banks the US has versus Canada. Very, very different. The other thing is, since 2001, 563 banks have failed in the US compared to 0 in Canada, because again, we have a different banking system with different mandates. Since the Great Depression, we've had in the US 9,000 banks fail since the Great Depression. 100 years since 1923, including the Great Depression. It's 100 years, whereas only 2 regional banks failed in Canada, small regional banks. Very different systems. So people can relax around kind of whether or not there's going to be a huge issue across the Canadian banking system, because, Patrick, I don't know about you, but myself, I don't anticipate a huge banking issue in Canada. That being said, investors will feel this, especially real estate investors, because lending conditions are about to tighten a whole lot more than they have been because of this sneeze in the US.
Well, it is an interesting time, isn't it? So you're right. Canada banks, way different. We just a couple of weeks ago talked about OSFI mandating the banks to up their reserve funds in terms of how they're supporting and backing mortgages should there be, a bunch of mortgage defaults. Now, we know that mortgage defaults are escalating. We'll talk about that later. and we have to pay attention to that. But at the end of the day, banks are not at risk in Canada in the same regard as they are in the US. But what is happening and what is interesting, a couple points that we'll hit on, which is, the demand for mortgages has dropped because people can't or don't want to loan or get a loan at these kind of interest rates. The other side of it, back to the problems that, Canada faces given what is happening in the US, is that the interest rates overall are increasing. And where we run into some problems, and we're starting to get kind of feedback in terms of when we look into leading indicators, businesses are not borrowing as much money, which then says, okay, well, if they're not borrowing as much money, and by the way, the banks are making offers to businesses to say, come on in and we'll write you a loan. The banks aren't wanting to actually borrow money at these kind of rates, which then at risk is slowing the economy down. So those are kind of leading indicators that we got to pay attention to. But that's all part of what's happening with the banking system. Everybody just gets a little bit nervous. Everything tightens up.
Yeah. And so as a real estate investor, here's what I say, Patrick. And I've been thinking about this because as this was happening, I was following this very closely. And I don't follow all the news stories very closely, but this one I knew would have a profound impact on us as real estate investors, because as a real estate investor, I rely heavily, we all rely very heavily on the banking system and on banks in order to be our business partners in this business called real estate. So one of the things I project is, if you're a real estate investor and your financial situation is tenuous, you're not necessarily as well capitalized as you should be, your loan to value ratios are a little higher, your leverage is a little higher, this is where the bank gets nervous, and this is where they pull term sheets. This is where you thought you had a deal, but you actually don't have a deal because they yanked that sucker out from under you. So if you're a real estate investor and you're currently sitting on a term sheet and you really want that money, you really want to finalize that deal, I would not be dilly-dallying, Patrick. I told you this the other day in a private conversation where I'm in the middle of a particular big deal right now, where I wanted to sign that paperwork right away. I didn't want to wait. I didn't want to wait a week or 2 or 3 to see what happened. I wanted to sign this paperwork because there's no reason the bank might say, you know what, I'll tell you what, how about we just don't do this deal right now? Let's just take a breath and pause and let this, see what happens in the US. This is what the banks do. So as a real estate investor, you're in the middle of a deal and you want that money, I recommend you sign that paperwork, or at least have a good conversation with your mortgage broker to say, listen, should I sign this or should we wait? Because these deals will disappear. That's my thoughts, Patrick.
Well, no, and I 100% agree. And even if they don't actually pull the loan, what they've done, and I've seen this happen before, I've actually had this happen to me back in 07, 08, right through that whole kind of crisis, if you want to call it that, is they changed the deal. So in other words, if you're not signed on that particular deal, they come at you and they go, well, we're just going to add this condition, or we're going to shift this ratio just a little bit. So these are things that, to your point, as everything gets a little bit uncertain, all of the banks tighten up here in Canada because, and let's face it, there's another side of that, which is, okay, it just shows responsibility by the Canadian banking system. So, again, that also gives confidence to other people in the banking system overall. So it's a balance I think the bank's got to strike. But as investors, we have to know that's what's happening. So to your point, don't kind of procrastinate in getting that paper signed.
Well, listen, and let's talk about what you just said, because you said something fascinating, which is they may not pull the deal as the example I gave, but they may change the ratios. So what does that mean to investors? What that means is, let's just say a bank had agreed to lend you 80% loan to value. You had $1 million building, they were going to give you $800,000 as an example. They may turn around and say, you know what, we're going to bring that ratio down to 75% loan to value or 70% loan to value, which means they will still do the deal. But Patrick, that means you got to come up as the investor with an extra 50 or 100 grand. And this could be monumental if you're working on many projects at once, or even if you're just getting started. I mean, to pop in an extra 50 or 100 grand into a deal that you didn't plan on could really make the difference between you saying, you know what, I can or I can't. And that's what's going to impact investors from my perspective.
100%, or they'll ask for more collateral. So, they already asked for your firstborn. They're going to ask for your secondborn as well, because they just want to make sure they're covered.
100%. So these bank failures, Patrick, from my perspective, these are the kinds of ripple effects I think investors, including Canadian investors, are going to see. If you're investing in the US, that's a completely different story, because they may have a whole different because they may be affected way differently than in Canada. And then there's also for business owners, because we know we get a lot of business owners who watch this show, there's going to be some business repercussions to this, Patrick. Like, for example, we were just told before starting the show, SVB, Silicon Valley Bank, Shopify was one of their big clients. And I know SVB had a lot of merchant processing as part of their business. And if Shopify is impacted, and if you're using Shopify as a business owner, I know you do, Patrick, as a business owner, I know I do in my multiple businesses, this could impact us in terms of getting our money and money flowing. This could be an interruption. Just got to be on top of your game is all. Don't let this just slide under the carpet is what we're saying.
Well, I think you make a really great point here, and something that we as investors need to look at. And even if you don't invest in the stock market, let's consider how nervous things are getting. Shopify over the course of this past year, maybe not even the full year, I think their share value has dropped about 70%. They came back up again, but it's been up and down, and still at the end of the day, it's at really all-time lows. But also to note is that when we look at our 5 big banks, whether it be TD, Scotia, RBC, HSBC, whatever that might be, the point is that their share value has come off a lot too. I want to say 20 and 25%, depending on when you want to look at the numbers, but over the course of, let's say, the past year. It's all to say that, investors overall are nervous. People are just paying attention to what they're doing. And if you're getting nervous about the big banks as well as a Shopify, that really speaks to just like I say, the nervousness of people in general. And I think that is a leading indicator into what it could create in the future in terms of economy.
And I'll give you one more kind of actionable advice for real estate investors, because as real estate investors, Patrick, we often, we go in and out of cash a lot as real estate investors. And sometimes we're very, very liquid. We refinance a property, we sell a property, and we go from having very little cash in the bank to having lots of cash in the bank. And for some investors watching this show, it's nothing to have 500 grand, 700 grand, a million, millions of dollars in the bank. Just keep in mind, folks, in Canada, that is insured up to $100,000, meaning anything beyond that could potentially be at risk. And one actionable item might be to spread some of that money between different banks in order to get a little additional coverage, Patrick. These are good risk mitigating moves that in a time like this may help you sleep better at night.
Well, that's great advice too, by the way, is to have, different banks and not have everything in one bank. And that includes, having your business account with your real estate accounts, with your savings account, your personal accounts. It really is good advice to kind of spread it out between 2 or 3 banks even.
Now, the other thing that this opens up the door to, Patrick, is these bank failures is 2 conversations, is digital currency, cryptocurrency. And I'm kind of lumping those together, even though they're not the same. I'm going to lump those together. And also these swap lines. You brought this up because I know you track this stuff quite closely. So this is where we're seeing kind of some behind the scenes, some of that central bank plumbing has got a lot of activity going on right now as they try to keep all these balls in the air. And so, Patrick, let's talk about swap lines and what that means.
Well, swap lines is where central banks exchange money between themselves. So, for example, Canada has banking system. So we got the Bank of Canada, then we got our banking system. And our banking system is doing business outside of Canada. It's doing business all over the world. So, for example, if Canada needs money because they're doing business in Japan or they're doing business over in Europe or in China for that matter, what they are able to do, exchange currency for that a currency that's needed in that country, so that country's currency. So these swap lines go back and forth, and it's all central banks around the world. Now, there's a next phase of this, which is, they don't want to use the term quantitative easing. So this is what is, putting more money into the market. Then, of course, we then increase inflation. And so they're doing bank rescuing, if you will. They're not buying out banks, but they're buying out and paying for these investors that have lost money in these bank failures. And so all of this capital has to come from someplace. And normally what they would do is just fund it. They would put it into the system through some form of quantitative easing. Now, they don't want to do that because they say, well, no, we're not going to do more quantitative easing. But what they do is they do it through these swap lines. And it's a very kind of complex issue. But if you see where's the money going, it's going amongst the central banks. And it's another form of quantitative easing, and they're just not calling it that. So there's a lot behind the scene called quantitative easing that isn't, and there's more money coming into the system. The underlying risk and the underlying impact of that will be, devalue of the dollar and, of course, more inflation.
Interesting, Patrick, that quantitative easing was, the narrative was that this was like the golden child, and this tactic that was discovered after the great financial crisis really saved the economy. And now that we've been battling this inflation issue, now quantitative easing is the bad guy. It's amazing how this narrative has changed, and now they're not even calling it quantitative easing anymore. Now they're calling it swap lines in order to kind of, muddy the waters a little bit. Just fascinating how they play these games.
Yeah, and they're not calling it swap lines. The swap lines have always been a tool. And it makes sense to have that tool, given that it takes the volatility out of the market, because, for example, if Canada is doing a swap with the U.S. in terms of the U.S. dollar, give me your U.S. dollars. If on any given day the dollar is going up and down, it just keeps some volatility out of the market in terms of what we have in our bank accounts, as in what the banks have in their accounts. So the swap lines are an effective tool, but what they've done is to use them as a workaround to quantitative easing. And that's really simplified, by the way, but ultimately that's what's happening in behind the scenes. So when we talk about this ongoing conversation about global inflation, what it means to us and how it impacts Canada at the end of the day, they just know that there's money going into the global system, and they're just right now using swap lines as a tool to do that, which is unconventional. And it's a way for them to avoid saying, well, we're going to do quantitative easing because we need to bail out banks and keep banks afloat. Because aside from the fact that these banks have gone down, JG, it's not like these 5 banks or 4 banks are, all alone. There is already a contagion effect that's happening. And so the feds, in terms of where they have to come up with capital, they've got to back a lot. So just as an example, I don't know the exact number, but I'm going to say that, let's say there's $100 billion or $150 billion as a reserve, but it's a reserve against $2 trillion being lent out. Like, it's an absolutely, to your point earlier, you said 3%, and if that's the number, that's great. I don't know what it is, but you got to put that in perspective, and the scope of the money that's flooding the system is just crazy. And so they're guarding it, they're guiding it, and the other banks are at risk. So they're trying to increase reserves, and they're using swap lines as a big tool to do that.
What impact does this have, Patrick? We've seen crypto rally like crazy in the month of March since kind of this started hitting. And, and when I say crypto, I mean specifically Bitcoin. I'm looking at the Bitcoin chart here, and it's gone from, if I look just in the last month, and this is in Canadian dollars, it's gone from 32 and it's now up to 39. It hit a low just literally just before this went down at 28, and then it took off. It's gone up 10 grand in the last essentially 10 days. Actually, it's gone up 10 grand in 10 days. What do you think this does for Bitcoin? What do you think this does for digital currency? Does this help the narrative? Does this change things? What's your thoughts on this? I know it's a big topic.
Okay, so let's break this down a couple different ways. So first off, we have to segment crypto as being a language that covers a lot of different language. I'm not interested in crypto per se. I think there's opportunities in crypto, but it's got third-party risk. Always keep in mind that crypto has the term crypto, even including Ethereum, by the way, has third-party risk. So that means that it can be at the effect of men doing something in the background or people doing something in the background with the system. So third-party risk, that's a kind of a really loose example of that. Then we've got Bitcoin, which really is undeniably no third-party risk. And then we got central bank digital currency that's being introduced. It will be rolled out, and we can have a little conversation about that. So if we break it down in that way, and then the other conversation that we should add to this is precious metals, specifically gold and silver, and probably even put some platinum in there. So you got these buckets. So here's what's happening. As people get nervous, as they see what's happening in the banking system, they go, okay, these previously risk-on assets like Bitcoin, even arguably precious metals, but certainly Bitcoin would fall into that. Precious metals to a different degree would fall into what they would call risk-on. But all of a sudden, people are in the banking system. They've got stuff in the stock market. They've got money in the bank, and then they go have money in bonds, and they're going, hold it, this is not safe at all. So they take money out, and they take those risk-on assets, and they are risk-off assets, and they risk-on assets, and they put it in there, becoming risk-off. They trust now that given where they need to put their cash to keep it safe, I need no third-party risk, Bitcoin. I need no third-party risk in terms of gold and silver. So these are alternatives that people are putting their capital into. And of course, bonds are there. People are rushing to bonds. They believe it's safe, but it's not a great return. So there has to be a counterparty risk reduction. That's what people are looking for, because if you got money in the bank, you're at risk. There's, counterparty risk that's involved in that.
Interesting though, Patrick. I think one of the things this could do, and this is the thing I'm watching for, is just how the same way. And I know that this analogy is getting old and it's getting boring, but it did do what we talk about, which is COVID accelerated the move, work from home. It accelerated many existing trends. We know digital currency, crypto has been a trend. It's been ongoing. It's been happening since 2008, 2009, 2010 is where it started. And it's been constantly getting stronger and stronger and stronger. And this could be the tip of the iceberg that tips that narrative over the edge and really gives it some legs to move forward. I'm curious. That's kind of what I'm watching for, to see, is this that kind of moment where people start going to this? And listen, you got real businesses here that cannot meet payroll because their bank has frozen their funds, because their bank has gone under. That doesn't have to happen very often, that a lot of business owners are saying, holy shit, wait a second, I'm going to move my money into something that I fully control, like some type of crypto vault where it's in it's not held by the bank, and I can't be at the bank's mercy. It's interesting, Patrick. This could be that moment. I don't know. It's too early to tell.
Well, it is. I don't think let's put it this way. I think that we have to consider a couple things. SVB, as an example, Silicon Valley Bank was a primary lender. I mean, that's who their clientele were small businesses and really into the startup businesses as well as the tech industry. Well, those businesses are all now out of luck. They're done. So when you think about the fallout of that, it's going to be impactful, and call it a leading indicator. It takes a while for this to work through the system. So to your point, is it a tipping point? I think we have to really be kind of mindful of the thought process, which is it's not going to work. We're going to wake up one day. We'll wake up one day and we'll hear all this news. It'll be bad news, etc. But the tipping point is more a reshift of the trajectory. So the trajectory, I believe, has changed. I think we're going to continue to hear about these kind of events happening, and that is going to drive people into these other risk now off alternatives, and Bitcoin is being one of them. So I think that's a consideration. Again, when you look at precious metals, I always look at precious metals now. I've learned to look at it as all I'm doing is exchanging fiat currency, which is, as we know, been watered down. There's lots of it in the system, to another currency called gold and silver. So with no third party risk. And the point of that, and I'm not trying to pitch anybody on gold and silver, I'm saying this is what people are doing. And that's why we're seeing a rise in precious metals. I can put, 3 ounces of gold in my jeans. I can go anywhere in the world and exchange that gold for whatever that currency is at that current rate. And so that really makes a huge difference in terms of what I can do with capital and how I can use it. So these are places where people are placing their capital, and it's why we're seeing that increase. It's really a case of demand, and people are moving towards it.
Interesting, I think, what the federal government is doing in the U.S. to bail out this stuff that going on specifically at SVB, which is they're backing the depositors, not the bank themselves, Patrick. And I don't know, I mean, I'm not a banking expert, and nor have I seen a lot of these bank failures because like we said, in Canada, there's only ever been 2 in the last 100 years. I've never seen a bank failure. I've never experienced a bank failure, but typically the Federal Reserve or the federal would back the bank. This time they're saying, no, we're not backing the bank. We're backing the depositors. How's that going to play out? Fascinating new move by the feds.
Well, and that's where I think it was UBS that bought out Credit Suisse for, a pound, like literally. So somebody else came in and bought whatever was left of them for, next to nothing. We'll take on your debt. We'll take on the problem. So I think that's what really they're looking to have happen. And I think it's a good move in terms of the feds. I mean, to your point, neither of us are bank experts. We only see what we see and kind of assess it based on the information we get. But I think it's a good move not to bail out the banks. Bail out the depositors. Got it. I would like to see some of those loans honored, for example, to the small businesses or the startups, because there's literally billions of dollars that is apparently going to be shut down. I mean, I don't have all the information on that, but that's going to have a ripple effect for sure.
The boys at the All In podcast actually say something fascinating, which, the companies that SVB backs and invests in, those are the companies that in 5, 10, 15 years, those are the next Googles. They're the next Apples. They're the next Shopifys. They are the next tech leaders. If you wipe that innovation out, that really could hurt the US, which is very, very interesting. It's all innovation, and it's very, very fascinating that if they wipe that out, this could really affect the U.S., which is already struggling with their global dominance. This could have a big effect on the world.
The All In podcast was great. Chamath even said, he thinks that this literally could set the U.S. back 10 years in terms of technology. Because, as he said, these startups, these tech companies that SVB was backing were really the next leaders in technology. And he, in his opinion, and he's got a pretty strong view of what goes on in that world, he feels that it could set us back 10 years in terms of technology development. That's huge.
We're going to keep watching this whole bank failures thing. We're going to see what else develops. We are going to see what the repercussions are in Canada as we talk to our various mortgage experts and banking experts. And we'll definitely be bringing this up in the next couple of weeks for sure, Patrick. It'll be a topic we watch closely, no doubt about it.
It's going to be great. It's going to be interesting to watch, though, but I think we have to pay attention for sure.
Bank failures. Done. Ooh, my aim is on today. Next, we're going to talk about affordability, and specifically affordability of real estate in Canada. It is, by many accounts, it's at an all-time low, meaning People can't afford homes. People can't afford real estate. Defaults are up, Patrick. We're seeing defaults are up. I know you put out an article that Toronto Star had a recent report on defaults. I haven't really got into that one yet, so I'll let you speak to that. But I will tell you this, and this, I got an interesting chart here I want to show, which is affordability is really has not only, even though the price of real estate has gone down, and I'll give some stats in a second, affordability has not improved at all. And here's the stats. So in the last year, from March 2022, which was the tip top of the market, to March 2023, which is where we are today, the average Canadian price, which we don't like averages, but for this point it works, which is the average price in Canada went from $796 to $612, 796 grand, and on average down to 612. Now that is not, just so everybody knows, Patrick and I hate averages, and that's because some properties went down much more than that, and some properties didn't go down at all. Some properties actually went up in value, but on average, which for this point, it has gone down $183,000 in the last year. But affordability, Patrick, the average mortgage payment with 20% down has went from $2,850 to $2,980, which is up $130. So even though the price of real estate is coming down, the actual affordability is going nowhere. It's gotten worse, which there's going to be hell to pay for this. It ain't going to be good.
This goes back to, the whole conversation around, interest rates, but also interest rates, inflation, the fact that people are not able to, and, there's one conversation that's had a lot, which is that even those families who could afford a mortgage payment can't come up with a down payment that's based on the down payment that they need to actually buy those properties. So these are things that are going to continue to happen. Now, in the case of the cost of living and the cost of borrowing combined, people have less disposable income, and that's the problems that we're facing right now. And the good news is that Tiff Macklem has paused on the rates, and I don't see a rate increase coming in the next one either, in his next announcement. But that's the challenge that we're facing right now, is the affordability will continue to be an issue. As investors, it speaks to the opportunity because we know that there's demand on the rental side, and the people who are renting is changing. So your demographic of renters is changing as well. It gives you a broader scope of demographic to actually set up and be specific in terms of who you're marketing to and who you want your demographic to be. And that speaks to the property type and the location that you actually invest in, JG.
We got this interesting chart I want to show about this debt to service ratio, which is interesting because disposable income required to meet debt obligations is almost 15 to 1 right now, whereas the interest payments are 8 to 1. So you need 8 to 1 just to pay off the interest because interest has gone up so much. Interesting chart by Acorn. And again, just points to the kind of difficulty and affordability until that supply moves. Oh, and I want to talk about supply. I'm not adding a sticky note, but maybe we'll talk about it now because it is time to talk about it. Patrick, we've been monitoring the spring market so far, and looks like JG's prediction of Sleepy 23 is coming to light. It is happening. It's a boring market. It's sleepy. There's absolutely no action happening out there for the average person. For some creative investors, we'll speak to that after, but for some creative investors, there's some good deals out there. But all in all, pretty sleepy because there's no supply. There's nothing on the market to move. As a result, affordability is going nowhere in Canada.
When I talk to realtors right across the country, when they do see deals come on board, they're actually seeing that are priced right. They're seeing multiple offers and they're gone in a heartbeat. So anybody who is putting property on the market that isn't, pricing it right, they're trying to come in too high. It's pretty quiet. But the big point to your point, of course, is that there are no listings coming on. People don't want to necessarily sell, and there's a lot of reasons for that. Number one is that some of them are already into mortgages that are still, sub 2 or 3%. So why do they want to give that mortgage up to go into a higher mortgage if they can't port that mortgage, or if it doesn't work to go to the bank and get that same mortgage carried over? But whatever they upgrade to, of course, they're going to pay a higher interest rate on. So these are all some of the issues that are behind the scenes in terms of why real estate isn't coming on. I know that realtors are hoping that now that spring has arrived, that they're going to see an uptick. We'll see what's going to happen. I mean, I think that there's a couple things, JG, around the sleepiness, to your point, is that it's just a reoccurring conversation. If you watch some of the social media feeds, and you're really listening to realtors that are out there talking about it, it's really the same conversation over and over and over again. Not enough listings, not enough sellers. The interest rates are still too high. Cost of living is too high. People don't have the money. They don't have the down payment. So these are just kind of the ongoing conversations. I don't know what has to shift, but here's the thing that, to your point, is that there is some great opportunities for investors, but you gotta dig, you gotta look. It's not like they're just laying on the street. We've said that many, many times, is that you've got to dig and you've got to get creative with your strategies, because you are in fact going to be able to help a lot of people solve problems.
Yeah, interesting that you mentioned that, Patrick, because one of the things we saw in this, and this is a Toronto Star article where GTA is seeing a surge in forced sale listings, and this is where, and we're starting to see this. We talked about this months ago, where this was going to be the next phase, and creative opportunities were going to show up. So we're going to see some defaults. But in Canada, if you're an investor and if you're waiting for a huge surge in bankruptcies, or anything like that, the Canadian system is not like the U.S. system, where you have a lot of defaults and you have a lot of, banks have already done this, Patrick. They've re-amortized a lot of mortgages. They've pushed off what couldn't be amortized in 25 years. They're going to 30 years. What can't be done in 30 years, they're going to 35. They're just continually going to stretch the amortization until it can be wrapped up into something that makes sense for the seller. Banks don't want to own this stuff. The banks don't want to own your property. That's the last thing they want. They want you in that property. They want you making your mortgage payment. And the bottom line is, because Canada right now has a very strong labor market, we are not going to see, and we're not expecting any more big drops in pricing. We think the big drop happened in the last, the first part of last year. And even the back half of this year, we've seen very stable pricing, Patrick, and that's because of our strong labor market. What's stopping the moves is this high interest rate. Like you said, people don't want to move. People don't want to get out of a good mortgage and a good property. Yes, they might be able to buy the next property for less, but the cost of interest is so much higher. It's not worth it. They'd be crazy to do that.
Well, they are, and so there's a couple of things around all of this, to your point about the banks are accommodating borrowers for mortgages to the degree that they can, and extending amortizations. They're actually, because of the interest rates, people are actually extending. They're only making interest payments on a traditional mortgage. So it's still a mortgage, but it's a line of credit, and they're actually not buying down principal, and they've extended that amortization. So banks are, in fact, putting themselves at a little bit of risk there, increased risk, but they're also making money while they're doing it. I think the other side of that equation is that some people are going to wake up in 2, 3, 5 years from now and realize that they've been living in a house that they've got no buy down in terms of mortgage, depending on what happens with rates, of course. So there's risk on both sides. And so as much as, homeowners don't want to default or they don't want to walk away, and I totally understand and get that, their underlying kind of, I don't want to even call it risk, but the underlying part of that equation is that they're not gaining anything either, which is, of course, what many homeowners want, is they want to have that equity gain, and they do that through mortgage buy down often if prices don't go up. So these are all things that are happening in behind the scenes that banks don't, to your point, banks don't want property. They don't want your real estate, so they're going to do what they can. As long as people are working, here's what we know about Canadians. Traditionally, historically, as long as Canadians are working, they stick handle, they get things figured out, they pay their bills, especially their mortgage.
Tell you this though, Patrick, before I crumple the sticky note, what this does is this only helps the rental market, because people that were out there thinking about buying are saying, listen, why would I buy something, put out all that capital, the 20% I need to go buy it, and then after 5 years, I won't even own the doorknob. Why the heck would I do that? I'll just rent a beautiful place. And what we're seeing is, again, more pressure on the rental market. And even though rents, I can tell you in my particular market, they've flattened out for sure. They've even come, some categories have come down a little bit, but let's be very clear. Their rents are still fantastic. They're still phenomenal. And unless you bought at the tip top of the market, then you might be in trouble. But if you've owned real estate for any amount of time, the rents are still very, very good. And what we're seeing is a huge push on rents. We're seeing a great class of renters, a phenomenal class of renters coming in, which doesn't help the lower end of the rental market. But that's a topic for another day, Patrick.
Yeah, and just as we finish this particular topic up, JG, I just want to shine a light on a couple things, and that is, folks, we talked about Barry Maguire, his rapid cash program. We brought Barry back in because we know the opportunities that are going to be there for those who take the time to gain that little extra education and then invest in a way that supports and helps solve other people's problems. This is not new. It's historically, this works. It's why we did it. We saw this coming. And, for those of you who still want to invest in real estate, I know the deals aren't falling, they're not falling off the truck. You have to go look for them, and you have to get creative. But if you're in there and you're willing to get creative and solve other people's problems, that's where that extended education is going to support you. And I really suggest that investors get into it.
I like it, Patrick. Creative buying as well as affordability covered. That was a good shot. Next, this is your segment of the show, Patrick. Tell us about Alberta and inflation.
Alberta rocks, and their inflation is far lower than anywhere.
Why am I not surprised you would lead
why
with
do
Alberta?
I need to add anymore? So we had fun. I was in Calgary.
I got to get you a shirt. Mr. Alberta. Hi, I'm Mr. Alberta.
Listen, I just follow the facts. It's the facts and the data, JG. It's not, don't take it personally. I love Ontario. It's just the facts and the data. And that says, guess what? Alberta's coming back. I saw a guy that tweeted yesterday going, oh yeah, it's like rinse and repeat, move to Alberta, get a job, buy a house, get laid off, lose your house. And I just about wanted to come right across, these kind of statements. And he happened to have a lot of followers. What's that?
Is he wrong?
He's 100% wrong. Here's the fundamental around all of this. So first and foremost, that is an old story. These are totally different conditions. We've never had this happening in the world before. So people want to keep going back to historical norms. Well, this is what's happened in the past.
Well, that's what's happened in the past.
Well, we've never had 1 million people in a year move into the country. We've never had the global economic conditions that we're facing today. So does Alberta stand to do extremely well? Yeah, they'd actually do better if they wouldn't have shut down pipelines. It's a different story. But Alberta, through the leadership that they currently have, guess what? They've expanded. They've got a whole different industries that they're opening up. They're being very progressive, and we're going to talk about it, even in terms of what they're experimenting with in terms of housing, taking office buildings and or commercial units, if you will, and converting them to residential. Now, they're the first, I think they're leaders right now in Canada to do that. So Alberta is being very progressive. The cost of living, I've hammered it, I don't know how many times, cost of living, cost of housing, no provincial sales tax, wide open spaces. Guess what? Jobs that pay more. That province will continue to do well. Now, if I tell you what, if Alberta's at risk, this whole country's at risk. So if Alberta goes down, we're all going down for whatever reason. But I'm saying right now, based on what we know, Alberta will continue to be strong. That's it. It's that simple.
For a while, this episode was becoming a sleepy episode, but now the energy you've pumped into it, because when I attack Alberta, you just come alive. I love it. I love it, big guy.
Well, I just go with the facts. The point is this, is that there isn't a province in this country that I don't love, but when I'm here to support investors, what I'm saying is you got to look at the data, you got to look at the facts. And JG, we would be remiss not to shine a light on something that we don't say often enough is, there's an old kind of tagline or whatever is it'll be different this time. Listen, I get that tagline, but it's not about being different. It's about looking at the conditions and saying, given the conditions, what could change, what might change, what will change. And the conditions are significantly different than before. We didn't shut down. We didn't recover from a pandemic. We didn't shut down like a global economy. We didn't have supply chain disruptions. We didn't have a market flooded with cash. I mean, these are all different conditions. So if you're looking at historical, and this is some of the problems that I see happening even in conversations with in the realtor space, for example, they're talking about historical. Well, this is what it was in 2008. This is what it was in 2000. I go, quite frankly, I don't care. These are maybe an indicator, but it's a totally different scenario than we've ever had before. And I think that's how, as investors, we have to look at the market.
So now that your Alberta rant is over, let me help. Let me give some substance to this here, Patrick. Which is what's a couple interesting facts happening in Alberta, which is the inflation. Number one, the inflation across the country continues to come down, which is why they paused the interest rates. Patrick is hoping, you're hoping, Patrick, and I agree that they that they hold again and they don't increase rates next cycle. And I think that's next month, right, Patrick? It's in April. The Bank of Canada meets again.
It's April, yeah.
So we'll see. We'll see what happens. What's interesting is that Alberta's inflation is coming down faster than the rest of the provinces. We've got this cool chart right here with the blue bars. You can see Alberta inflation is 3.6%, which is still compounding more than the Bank of Canada would like. Compare that to BC at 6.2%. That's almost double, Patrick. BC, good old bring cash. Prices always going up in BC. So that's fascinating. And also compared to Canada as a whole, we have this cool chart by the ATB where, again, Alberta coming down faster than the rest of the country. Very, very interesting stuff happening. And Patrick, even though I bust your chops about Alberta, listen, I listen very closely. I've been investing heavily in Alberta, and I love it. It's doing very, very well for me. 70.1% ROI in the last 14 months for one of my investments. So thank you for that, Patrick. I owe that all to you, Mr. Alberta.
Hey, well, listen, good. I'm glad you're making money, and that's awesome. You could maybe share some with me when you got a minute. But here's the thing around all of this that we have to look at. So, Mr. Alberta, I get it, but understand something is what we're seeing is a lot of interprovincial migration and immigration coming into the province. And so keep in mind one thing, in that as that comes into the province, people are spending money. There is the risk of that inflation coming up again. Certainly, we know as investors that will drive house prices and that will drive rents. So that's on the good news from an investment point of view. Alberta has a great future. And you look at what's happening in Calgary, Edmonton, Lethbridge, like some of the surrounding areas. I think Alberta just stands to do extremely well. But always, we got to monitor what's happening. And here's where all bets go off. And I know this is political. I'm going to say it anyways. If the NDP gets in, all bets are off, because that'll change the game, perhaps.
Yeah. Didn't you guys make that mistake only a couple of years ago?
Well, it was a while back, and there's not you guys. There were some people of the province thought that NDP would be a better government, and I just don't agree. So that's what I got.
I love it. Now, you made a mention, Patrick, of a couple things. Number one, you talked about how some commercial spaces are being converted into residential. We knew when COVID hit, first thing we talked about, Patrick, was how some commercial space, because of the work from home movement, we'd have a kind of a pretty huge spike in vacancy in commercial space. We then went ahead and saw that spike, office space increase. And now we're seeing some of that space being repositioned in the marketplace as residential. Actually, Calgary, I think, is kind of one of the leaders in this space. And even though occupancy of office space is starting to rise up again, it's still not where it was pre-COVID. We got a cool chart on that where pre-COVID occupancy was at 55% midweek, and it's currently still at 43%. So 10% down from where it was. Interesting how that market is coming back, but slower than anticipated. And will it ever recover? We expect no. It will never probably go back to where it was, Patrick. At least that's what I think.
Yeah, I saw some notes. RBC's putting some pressure on employees to start coming back to work part-time. They're saying they can't, by not being together, they're not being as competitive in that market. I understand that. So I think we'll see some pressure in these bigger corporations on employees to get back into the office. And I'm not here to debate whether that's smart or not. I just think they're going to be kind of facing some headwinds with people in general that just are not going to come back to work in that way. So there's some inherent risk in making and forcing the river in that regard. I think on the other side, though, back to the Calgary component of it, this is, again, talking about the innovation. We often talk about, JG, about the economic development. When you're looking at a city to invest in, you have to consider the economic development. Are they progressive? Are they looking into the future? And, when we talked about Hamilton and Barrie and all the areas in Southern Ontario that we used to shine, or well, we still do, but we shine a light on, it was because they were being so progressive. Here in BC, it was Surrey was being the progressive, and then Abbotsford. So when we look at economic development, when we look at Calgary and what they're doing, so the city of Calgary actually was part of the investment with the developer on these projects that they're working on. Now, it seems so simple, right? Well, just take an office building or take this particular commercial space and turn it into residential. It's not that easy. It's a huge project because of how everything from plumbing to electrical they have to redo the whole thing, because within the scope of what works for residential, they have to look at reconstructing all of it to make it work. So these are bigger projects than it would seem. It's not like, oh, let's just turn that office into somebody's apartment. It's not that simple, although it would be cool if it was. It's not.
And even the construction, Patrick, let's just say the construction could be handled relatively easy, which often the construction is not the part that holds people up. It's the zoning. You got to come back to the administration of that building. If it's zoned for an office space and has no components of residential, you cannot put a dwelling in an office space. It's illegal, and they can shut it down. So the city actually has to push through, residential applications to that zoning building. And then guess what? This is where the good old NIMBYism kicks in. And then, all the Karens come out. I probably shouldn't have said that. That's definitely offside, but that's okay. It's out there now. But NIMBYism becomes a problem, and that's where projects get stuck. It's actually the construction's relatively easy to handle compared to the other stuff, because we can run some pipe, we can do things on the construction world to make it happen. But that other stuff, the stuff that happens at city council, the stuff that happens behind closed doors that we have no control over, that's the more difficult things.
Yes, you said it all right there. But the good news is around it all. Just want to say the good news. Go. Last thing. Go.
Just go.
You go.
You say it.
You go. No, I was just going to say, I was going to wrap it up and just saying the good news around all of that is that Calgary's being very progressive in what they're doing. And I think that's going to open up some opportunities, maybe lead the way for places like that, in Toronto, for example, to maybe shift some of their view of the world. Maybe.
Let me just back up one more piece of your rant there, Mr. Alberta, which is we got this cool chart about how Canada's hit a population milestone where actually yearly percentage change in population is up 2.7%, which is the most we've ever seen. If you look at this chart, it's almost off the chart, if you will. And a lot of those people are flowing into Alberta because of the cost of living and because of affordability. That's what you were saying too, Patrick. I like to add context to your rants because they get all very politically charged. I'm just adding some depth to them, if you will.
Well, I'll have you know that I was just in Calgary, and we put together a live in-person event with one of our trusted partners. And many, of course, were from Alberta, investing in Alberta. And it was really, really simple to explain to them. It didn't sound like a rant at all to the locals that were in Calgary that night and from across the province, because we were just talking about the economic facts and the economic data. Rant aside, it was very straightforward.
Alberta and inflation covered. Patrick, next we're going to talk about the China-Russia deal. This is actually quite fascinating because to the less aware viewer, this China-Russia deal was going to happen. Doesn't mean anything. What's the big deal? It's China, it's Russia, it's over there, it's on the other side of the world, has nothing to do with Canada. Does this really matter? So if you're kind of an unaware viewer, kind of maybe that's what you're thinking. I know, maybe I would have thought that at one time, but this kind of deal has ripple effects, not only immediately, but quite frankly, most of these ripple effects will pay off in 5 years, 10 years, 15 years. And it happened yesterday, March 21st, 2023. First and foremost, maybe Patrick, if you're up to speed on the deal, describe kind of what the deal was about, and then let's pontificate on where we think these ripple effects are going to show up.
Well, at the end of the day, what Russia and Xi Jinping did in China was they signed a deal. They signed an agreement together to exchange and to pay each other back and forth in the ruble and in the yuan. And so guess what? They're cutting out the American dollar. And so as much as we put pressure on Putin, for example, in terms of, sanctions and all the things that we did in that regard, guess what's happening over there? Putin is hanging out with China. He's hanging out with all of these other countries, India, for example, becoming pals. And he's really expanding. What's going to ultimately happen is he's going to expand the BRICS. There's already a lineup of countries that want to be part of BRICS. I don't know what they're going to call, what that acronym will become. And to the degree he also paid off a bunch of debt of Africa. So he's building his own kind of divisive world that in terms of doing business. So as much as we've laid these sanctions on him, he's simply going to other countries and getting the goods. And of course, so money isn't, or we're not exporting. And I mean, we as in the West is not exporting the goods that we would have exported in the past. So, at the end of the day, what we see start to happen into the future, and when we have to kind of look into the future, is it's very, very likely that at some point the U.S. could lose reserve reserve currency status. Not going to happen tomorrow, but that is certainly a risk. I mean, if you want to talk to some of those that are, the big Bitcoin bugs or the big gold bugs or whatever that might be, that kind of alternative currency world, they're saying it's definitely U.S. is going to lose reserve currency or reserve currency status. I just don't know how quickly that's going to happen. I think the trajectory's been set, and I do believe it's going to come to that, but it may not be in a lifetime that we see or care. Maybe.
Yeah, gotcha. Well, speak for yourself, Patrick. Maybe not your life.
Yeah, you're a young man. You're just a young man. You got it. I keep resisting. Whenever I'm talking to you, JG, I have to say that I keep resisting. I saying I remember when. I try and avoid that saying.
So a couple different thoughts on this, Patrick. First and foremost, for those that are watching this and kind of don't know what you're talking about, losing, global the reserve currency. There's a great book by Ray Dalio, The Changing World Order, that you should read if you want to know what Patrick's talking about. If you want to see kind of where one guy sees it going, based on a very interesting study of, I think, 1,600 years of data. Go check that out. Go read that book. It's a very, very fascinating book. But Patrick, I think this actually stems back, and we actually saw this, and I know that we're talking about the China-Russia deal, and there's a lot to discuss here, but this actually started when COVID first happened. And we saw this. We've been living in this world of globalization for the last 30, 40 years, where we've been progressively getting bigger as a global community. And when COVID happened, that was over. That was done. That was done. We went, in my world, we went to a more regional approach, and you started seeing the US bring back stuff onshore, and you started seeing Canada brings back stuff onshore. And I'm not talking about just masks and respirators. I'm talking about the semiconductors that are being moved out of Taiwan back to the US, that are being built in Dallas, just as an example. And I think that the world of globalization is going to be shifting a lot. And this is an example of that. And this is one of those repercussions where Canada, the US, Mexico, and even down into Central America and Southern America are going to see a much closer alliance than with the kind of the east side of the world. Fascinating where this is all going to go. And you and I actually talked about this when we did a special at one of our live events during COVID. We talked about how the world of regionalization could really shift the landscape of real estate. Too big of a conversation for this particular episode. But the point is that we are going to a world of regionalization, in my view, not globalization. And this is an example of that, where you have two countries that are kind of giving the finger to many parts of the world, saying, listen, we're going to do business together. Hell, the repercussions to pay. And this does open up the door to a lot of different things, like back to the conversation about digital currency, back to the conversation about, U.S. losing their reserves status in terms of their currency. And in terms of this changing world order, very interesting where this is going to go. But man, it is going to unravel, and it's going to be messy on the way down, Patrick. That's what I predict.
Well, no, I think, and I agree 100%. I think there's a couple things that we have to point out here. First and foremost is that, we're living our life. We're doing our thing. We got to get up. We go to work in the morning. We provide the services. We provide value. We just keep doing things and moving forward. In parallel to all of that, we have to be aware of what's happening on a global scale. So, people will look at it and not recognize or not see it on mainstream media, so they may not be aware of just how much unrest there is in other countries. France is literally melting down with not just riots in the street in Paris. It's right across France. We're seeing huge upset in what's, in the residents or the people of that country, pushing back against what's happening with some of these government initiatives. So we have to look and say, outside of what the risks are in terms of our own country, we are at the effect of what's happening globally. So this goes back to, as investors, we say, well, where do we put our capital? If it's not safe in the bank, and what do we do? And there's no real estate for sale. But this is where I think, the extra 10%, if you will, it's why we hear the stories of the 1%ers or the 10%ers. It's the reality is that it takes extra effort to actually plan and know that stuff's going on. Don't let it be too big and distracted, but plan for it. So in other words, hope for the best, keep going forward as if things are going to work out fine, because we've got great leadership, all of those things, got it. We're just going to keep moving forward. But in the meantime, where do we hedge our bet? And, we talked about it on many shows and with our members many times. We still believe strongly that real estate is a way and a place to put your capital in order to keep it working and kind of keep it safe, if you will. Then if you want to look at things like Bitcoin, you want to look at precious metals, these are other alternatives that are actually hedging on the potential risk of what's going on a global macro scale. The challenge, JG, is if you're not looking for it, if you're actually not doing the research, a lot of this is just not showing up on mainstream media intentionally. Now, I don't disagree with it, by the way. I mean, if people really understood what was going on a bigger picture, I think there would be kind of like people freaking out because there's a lot going on. So that's what I got to say about it. And here was my test. So it wasn't even a test. As you know, we went to Edmonton, we celebrated my mom's 95th birthday. Awesome. Love the fact that my mom's still here to celebrate at 95. And in that whole party was a bunch of nieces and nephews who are now in that 35 to 40 range. And as I'm having conversations with a couple of my astute nephews who are very accomplished and are doing a lot of stuff, they literally have no clue what I'm talking about. I said CBDC and they went, "What's that?" And I kind of told them, and they go, "Oh, yeah. Like, I know what you're talking about." They don't have a clue what I was talking about and what the impact of CBDC could represent. And so this all to say that people are not as informed as we think they should be, if they want to stay ahead of it and actually succeed as investors, JG.
I think this is going to take decades to unravel. I think this is one major domino, which opens up the door to, CBDC is 100% happening. What we're going to do about it is different, but I actually think CBDC is going to pave the way for other digital currencies, which is what we're more interested in than anything else. So that's for another time. One of the things as part of the China-Russia deal that was not, from my research, was not part of the deal yet, but China's pushing for it hard, is they essentially want to rewrite the pipeline. They want to reroute the pipeline from Europe and send it straight to China. And that hasn't happened yet, Patrick. But when it does happen, my question for you, Mr. Alberta, is what are these effects on our prairie provinces, including Alberta, Saskatchewan, that produce a lot of energy? And does this open up more opportunity for us here in Canada?
Well, we'd like to think it does open up more opportunity. At the end of the day, we're at the full capacity of what we can refine, because ultimately that's what we're trying to sell. Without these pipelines, without transportation, it takes years for these things to develop and to evolve. It's really hard to increase capacity. We could increase refinement capacity, then we don't have it, but it even takes time to increase refinement capacity. So we're kind of limited to what it is. But Alberta and oil aside, Canada is a country of commodities. We have what the world needs. I say it time and time again. I'm still just shocked, and I have no idea what the explanation is that why are we not actually exporting more of our commodities? We can do it environmentally and in an environmentally responsible way. We're just not. It always has kind of stymied me, and I'm just not smart enough to figure out why our imports and exports are kind of balanced. Why are we not? Our exports should be through the roof relative to what we're importing. It's not the case. And so I don't know what's going on in that regard. But when it comes to oil, and we're going to bump up against the capacity of what we can actually even refine and then transport. Those are capacity issues. That's government.
This domino, which is a big domino. It's not the first domino, but it's a big domino that has an effect on this new, what I would call regional world instead of this global world, this new regionalization movement that I think we're going to see in the next 10, 15, 20 years. That will have an effect on real estate for sure. We did a conference, Patrick, on this. I forget the name of the conference now. We did it during COVID, and we talked about how the world could be very different in the next 5 and 10 years. And this is what we talked about then. And people were asking ourselves, what's going to cause this new world? We're living it right now. This is what we talked about 2 years ago during these conferences. It's starting to happen. So fascinating that we're seeing kind of some of the predictions we had happening in real time here.
Yeah, it's all starting to unfold. And that includes, by the way, 2 years ago, I presented and even talked about 15-minute cities. And it was very, kind of new in the conversation, but ultimately we're starting to hear and ramp that up, the whole conversation around 15-minute cities, and have to really start to consider what does that mean to real estate, and don't have the answer to that today, but as well as 5G, and what is that going to mean when we start to look at the technology that's going to allow us to drive. All of these things are happening, and they're really in progress. They're probably even further ahead than we're aware of. And so we look at smart homes, smart cities. It's going to change the game for sure. And I don't think it's going to be, 20 years is a long time. I think we're going to start to see the effects of it in 5 and 10 years, 5 years for sure. I think we're going to start to see it.
I think we're already seeing some of the effects. They're just maybe not on everyone's purview, but we're already starting to see some effects. This is something we're going to monitor very, very closely, the China-Russia deal, and report back, no doubt about it, because it will have a repercussion for a long time to come. So enough on that, Patrick.
Enough on that.
Let's talk about the budget. Let's talk about the budget. There's two things. I know you're dying, so I'm just going to tee it up for you beautifully. Canada recently went from number 5 in terms of the world's happiest places to live to number 13 in the last 8 years. Patrick, what the hell's been going on in the last 8 years? Why would that happen?
What has happened in the last 8 years? Where this came up is that Jagmeet Singh, of course, who's got the coalition with Mr. Trudeau, went out there and he goes, I know some of you are struggling and actually suffering, and I understand that, and just know that I'm with you and I love you. That's literally what he tweeted. And I couldn't help but respond to say, Jagmeet, your patronizing tone is almost nauseating. I'm just telling you what I said because it really pissed me off. And then I shared that screenshot that you have of this recent status of what's happening. So as much as we've had, our current prime minister leading the pack, we've got our NDP, federal NDP, supporting that through that coalition. And, I think the results speak for themselves. People are not happy. Okay, end of that.
End of rant. Okay, let's talk about the budget. What's going on with the budget? It's going to come out in the next week. Fascinating. These budgets, by the way, Patrick, every single year, it's important for viewers to understand this. They put out a budget, and then what happens? Because what they put out and what actually takes place are two very different things usually. But tell us, where's this going to start from? What's the narrative that's going to hit the streets here in the next 7 days?
Well, the way I see Chrystia Freeland positioning it right now is what she's saying is that they have no choice, but they're going to have to spend more money, and they're going to have to invest it wisely. And, in this particular conversation, we don't know what the budget's going to be. Of course, it's always kept secret until it's released, but she's already putting it out there. She's pre-positioning it, which is that we're going to have to spend more money, but we're going to invest it wisely. And it's because of the pandemic that we find ourselves in this position. And, from my point of view, it's not about the pandemic. It's just about poor judgment by our government and our Bank of Canada through that period of time. That, regardless of what I see it as, doesn't matter. Here we are today. She's going to spend more money. And what we need to read into that is that, in fact, taxes will continue to rise. They've already made the announcement that taxes are going to, I want to say, hit almost 60% on incomes of over $221,000 or over. And so that may, to some people, go, yeah, I wish I made that much money. But at the end of the day, that affects the economy as well. So these are all ways for them to, justify tax increases as well. They'll say, look at what we're giving you at this end. And so that's it. It's too early to say anything other than Chrystia is already positioning it that's what they're going to come in with, a more spending, which means higher deficit and higher debt. We need more of that.
We definitely need more of that. Now, interesting, Patrick, because we don't have these numbers yet. They're going to come out in the next week. But in the U.S., they do have a budget, I think, in front of Congress right now. And some of those tax increases are quite crazy. I mean, we're talking about doubling and tripling tax rates. And in some cases, a 4x increase in tax rates on certain different taxes as part of, and I don't know the U.S. tax system that well, but some of like, for example, their corporate income tax is going from, I think, like 10.5 to like 29% or something, and again, I don't have those specific numbers, but the point is that what the U.S. has proposed in terms of tax rates are incredible. There's been some huge increases, and I'm not going to be surprised when Canada proposes the same thing in the next week. And then we're going to have to dive down and see, how much of this stuff actually gets implemented. Because just because the budget comes out doesn't mean all this stuff gets ratified and all this stuff gets pushed through. That's important for Canadians to understand, is that just because it's proposed, just because it's in there, doesn't mean it actually makes it all the way through. So we'll see what comes of it.
I think there's a couple things around it, and it's hard not to be kind of, I don't know what the right word is, but you look and you step back from it, and we look at the cost that we keep talking about CPI in terms of inflation. We know that, for example, shelter costs, you've got interest on your properties, on your mortgages, for example, that's part of the shelter cost. So the Bank of Canada raised rates, and that was part of what increased inflation. But what we don't talk about, and what's never talked about, is how much of the inflation that we're facing and that we're faced with is really from taxation. And whether it's a direct taxation on our income, or taxes that are passed on through corporate taxation, or gas taxes, or now the booze tax has gone up. I mean, all of these things are, really, increasing our cost of living, but they're not part of the CPI basket. And I always think to myself, wouldn't it be interesting? What would inflation be if they added tax to the basket? Oh boy.
We're going to watch the budget very, very closely, ladies and gentlemen, because it will be very interesting. And that's coming out in the next 7 or so days. Patrick, we do expect we're going to cover this in the next episode of Rein It In.
So JD, when we look at what's happening in the world today, it can really sound doom and gloom. It really can. And, we're at the effect of it because of the research we do and the research the team does. But ultimately, we have to look at it from an investment point of view and say, whenever there's confusion, whenever there's chaos and uncertainty, lives the opportunity. And we have to kind of live by that mantra. We have to move forward in what we're doing by that mantra, because everybody else is, not moving. They're being frozen. They don't know what to do. They're not making decisions. For us as investors, we have to say, where's the opportunity? Well, one opportunity that we see is in the pressure and the problems that are being created by the shift in the economy, and certainly in interest rates, mortgage rates, what's happening in the housing world. And so for investors, it's why we brought back the program of Rapid Cash, looking at agreements for sale, looking at wholesales, rent to own, and being very creative in solving other people's problems is what opens up the door for us to grow a very profitable portfolio. And, all of this, like I say, sounds doom and gloom, but all of it is to say that there's a ton of opportunities we got to pay attention to.
When in doubt, zoom out. When in doubt, anchor yourself in the fundamentals. That's what you get here on this episode of Rein It In. Hopefully you've enjoyed, ladies and gentlemen. Please like and subscribe, share, put some comments below, and we'll see you on the next episode of Rein It In.
Thanks, JG.